In his recent budget, Rishi Sunak announced, among other things, some tax giveaways to home buyers, support for first-time buyers, and further COVID-related financial support for everyone else. But did you know that barely 3 weeks later, the UK government quietly announced some more tax changes? And yes, if you're employed, you own a holiday home, you have a pension, or you have to deal with a deceased person's estate, this affects you. But don't worry, you don't need to read all 30 of the tax updates, consultations, and other documents that were published after the budget, because I've read them for you. And in this video, I'll break down the headlines that are most likely to be the things that you need to know about. I'm Jason Butler, and I'm one of the best qualified and most experienced personal finance experts you'll find on YouTube. I can help you master your money so that you worry less and you live more. Sound good? Then hit the subscribe button and bell below so you keep up to date with all my new video content. Here's what you need to know about those tax publications if you're a UK resident. The government proposes a package of measures to clamp down on promoters of tax avoidance schemes and arrangements. Now, you have nothing to worry about unless you're involved in dodgy or contrived tax schemes. If you know anyone who is, perhaps you could let them know that they're likely to find life a lot harder in the future. There will also be a review of business rates with an invitation for feedback from any interested parties. Now, I'm doubtful this is going to lead to any meaningful change, but I'm very happy to be proven wrong. Now, if you own a holiday let or are thinking of buying one, listen up. There's going to be a change to the criteria for determining whether or not a holiday let qualifies for business rates. In England, a holiday let is currently liable to pay business rates when the owner declares that they intend to make their property available to let 140 days in the coming year. But there's no requirement on business rate treatment to undertake checks that a property is commercially rented out. Now, most holiday lets registered for business rates have a rateable value, which enables them to qualify for something called small business rates relief, and as a result they pay no business rates at all, and of course no community charge. The new rule will mean that the property must be actually let for 140 days a year to qualify for business rates rather than community charge. Now, this new rule may well push up costs for owners of holiday property that aren't actually let out much. And if this affects you or anyone you know, then you might need to increase your marketing, reduce your prices, or both. But thankfully this year, with few people likely to holiday abroad, demand for UK holiday homes is expected to be very strong. There's also going to be a consultation on a new tax on the largest residential housing developers. The new tax would help pay towards the cost of cladding remediation. Now, whether this is going to lead to more extensive and faster compensation for owners of affected properties remains to be seen. If you're a first-time buyer, then you might want to check out my recent video with my 7 top tips. There will also be some technical changes to pensions legislation. For example, it should be easier for a member to have their pension scheme settle any annual allowance tax charges from previous tax years by reducing their future pension benefits, and that's known as scheme pays. There will also be a review of land and property VAT via a call for evidence. We may well see the VAT treatment of self-build and other new property change, but you should be okay if you've got a project coming up in the next tax year. There was also confirmation that the simplified claim basis of the work from home tax allowance would continue for 2021-2022. And that means that you can claim tax relief of £6 a week if you're an employee who is required to work from home by your employer. And that's worth £62 if you're a basic rate taxpayer and £125 if you're a higher rate taxpayer. And you can claim by either calling HMRC, online via your tax account, or via your tax return next year. The government has also confirmed its commitment to fully digitising HM revenue and customs systems insofar as it relates to inheritance tax. Now, quite what that means is unclear, but hopefully long-form paper will become a thing of the past. And the temporary exemption from having physical signatures on inheritance tax forms has been made permanent, so that should speed things up in the future. And the rules have also been changed to mean that the vast majority, about 90% of estates with no inheritance tax to pay, will no longer have to report to HMRC at all. Now, what wasn't in the publications issued the other day was any proposal to overhaul the rules and rates of inheritance tax, but I think that's merely a postponement of the inevitable changes to this tax, because dead people don't vote, and taxing their wealth is one way to repay all that money we've been spending on the COVID pandemic. Now, in the UK, we currently have some pretty good ways of avoiding or reducing inheritance tax if you know what to do and you're proactive. A married couple or civil partners who own or own property can pass up to £1 million tax-free on their death. Without property, the tax-free amount is up to £650,000 for couples. So most people won't pay inheritance tax at all. But if you or anyone in your family has more assets than that, there are things that you can do. And there are several gifts that are immediately exempt from inheritance tax, including transfers of assets to your spouse or civil partner, regular gifts from your normal income, gifts of qualifying business holdings and assets, gifts to charity, an annual gift allowance of up to £3,000, annual gifts of up to £250 to any number of different people, gifts to someone getting married of up to £1,000, £2,500 if they're your grandchildren, and £5,000 if they're your child, and paying the living costs of an elderly relative or a child under the age of 18. And gifts which you made over 7 years ago and survive then fall out of your estate immediately. Check out the government website for more information on inheritance tax. And remember that because inheritance tax can be complicated, it makes sense to take professional advice from a solicitor, a tax advisor, or a financial advisor, and their fees should be a fraction of the money that your family will save. Dealing with a deceased relative or friend's estate can be a stressful and overwhelming situation, especially if their estate is neither small nor simple. And a good family solicitor or licensed probate practitioner can take the strain and help sort everything out. King's Court Trust was the winner of Probate Provider of the Year at the 2019 and 2020 British Wills and Probate Awards. Yes, they do exist. And they help families all over the UK deal with estate administration. And they've got some fantastic resources on their website that explain what you need to know and do if you are an executor or a trustee of someone's estate. And their website details are here and also below this video in the notes. And do make sure that you and your partner and your parents have a valid will. You can do a simple online one for less than £100 using either Which or Fair Will. As well as no changes to the rules and rates of inheritance tax, there was also nothing in the bundle of documents published on the 23rd of March that made any proposed changes to the tax treatment of pensions, especially tax relief on contributions, or any changes to overhaul the rules and rates of capital gains tax, or any major changes to VAT. The government probably doesn't feel it's the right time to start making significant personal tax changes as we slowly emerge from the pandemic and the economy is still recovering. Be under no doubt, tax changes and increases are almost sure to come over the next few years. Now, you can't control future taxes, but you can, to a greater extent, control your earning, spending, saving and investing decisions. And you can also make use of all the various tax incentives and allowances and reliefs currently available to help you build wealth and achieve and maintain financial independence and freedom. So make sure you check out your pension funding, including tax relief, your capital gains tax situation, especially if you have stocks, shares and property, and your family inheritance tax exposure. Well, that's enough excitement for one video. If you enjoyed this video, please give me a big thumbs up below, and remember to hit the subscribe button and the bell so that you never miss new content when it comes out. This helps grow the channel, and we can get essential financial education and insights to more people. Remember, you're looking to make progress of your money, not achieve perfection. Best of luck. See you next time.